So let's take a look at a few examples here. So the first question, up top here you have just an example of several different securities, and we're going to assume for the first part of this problem that these are trading securities. So these are stocks most likely that we are planning to sell in the very short-term future and hope to make money off of. And now all of a sudden we have December 31st rolls around and we have to do financial statements. So in order to do that, we need to look at what the cost was to us of purchasing these, and then also as of December 31st we need to look at the fair value, and we need to make some adjusting entries based on the fact that these are trading securities. So for security A, it looks like we are losing or have devalued our security by $1,500. So we want to show that the value of that security has gone down by $1,500. So we are going to debit unrealized loss income, showing that it's going to be on the income statement for $1,500. And then we are going to credit market adjustment trading to show that this is our trading securities for $1,500. Okay, so remember, this one here, market adjustment, is what we're going to net against our investment account to show what the current value is of that stock. So this would be netted with the debit that we originally did of $17,500 to show that the current fair value is $16,000. Okay, so same format is going to be true for security C here. So we'll go ahead and do that one next. So we're going to have unrealized loss. It's going to show up on the income statement. That one's going to be for $4,000. And then we're again going to have a market adjustment. Trading securities, $4,000. Okay, and so the only security that we have, B here, that actually went up in value. So we're going to have our market adjustment will be in the debit category this time. It's still going to be trading, and that's going to be for $1,500. And then we're going to have a credit to unrealized gain income for $1,500. Okay, so those are the two scenarios. It's either going to go up or down, assuming they're trading securities that are going to be very short-term investments that we're going to turn over shortly. This is how it would look like. So now down here, we're going to assume, instead of these being trading securities, that these are actually available for sale securities. Okay, so it's going to look very similar to what we have up here. The difference is mainly going to be in the naming of these accounts. So we're still going to have an unrealized loss, but instead of going on the income statement here, it's just going to show up in equity for $1,500. And then our credit market adjustment here would be in available. You could write out the whole available for sale securities, but in the interest of space, I'll just leave available on there. Okay, so still same number values because we're still changing it to the market value. Only real difference is where this shows up on the financial statements. Okay, so for these categories here, none of that actually hits the income statement. So none of it affects kind of your picture of how things went this year. So again, even if we have a gain, it's still going to be something that doesn't hit the income statement. Okay, still going to have the same numbers here. And then finally, you will finish this last category out. Okay, so as you can see, the numbers didn't change at all here. The only thing that changed was the name of these accounts, and the change from market adjustment trading versus market adjustment available just shows that those are categorized by being available for sale securities or trading securities. The change between unrealized loss income and unrealized loss equity just shows where that's going to show up. Whether that's going to affect the picture of this year's economic situation, or whether it's just going to go into the running total of the balance sheet like it does here. Those are the main differences there. Okay, let's go down here and let's look at the next question. Assume that A Corporation purchases 3,000 shares of B Corporation common stock for $10 a share and a total of $500 in broker fees. Okay, so assuming that A's total ownership in B after this purchase is less than 20%, how do you record the purchase? Okay, so when we're recording purchase of stock investments, we're going to use the cost principle, and we're just going to total up the total cost of this transaction. So it costs $30,500 of cash in total for us to get these stocks. So the cost of the stocks plus the broker fees. Okay, so it's kind of a trick question here, because we're now asking, what about if it's 35%? So now it's in that next category up of 20 to 50%. Well, while it is true that that changes the category, the initial purchase of stock is the same for all of these categories. How you record the purchase will still just be a debit to stock investment for the total cost of the purchase, credit to cash, just like that. And like I said, for anything that is over 55%, we're not going to worry about it for the scope of this class, and we're just going to say consolidated financial statements. That's all you need to know about once you're in control of the company. Okay. So now, new situation, assume that B Corporation owns 40% of C Corporation stock. C Corporation has a net income of $160,000 and declares a cash dividend of $40,000. How does B Corp record these transactions, assuming the initial sale was already recorded? Okay, so since we own 40% of the company, we know that we are going to actually record, as if we received this in cash, 40% of both the net income, which will raise our stock investment, and the cash dividend, which will lower our stock investment. Okay, so how do we do that? First, we need to know what is 40% of 160,000. Okay, so we can just do a formula here. 4 times 160,000, we get 64,000. Okay, so let's actually move that over here. Okay, so what are we going to debit here? We know we're going to debit and we're going to credit. The number is 64,000 for both. Okay, so debit is going to be an increase to our stock investments. Whoops. Okay, and then credit is going to be revenue from stock investments. Okay, so that shows us our portion of the income. We've recognized revenue, and we've also raised our stock investment account. Okay, and then for the dividend, do it like this. Now for a cash dividend, we own 40% of the company, so we are going to get cash. Doesn't matter what percentage of the company we own. They're still going to pay us out cash for these dividends, and that's going to be $10,000, which is, I'm sorry, not $10,000, but $16,000. Okay, and this is actually going to lower our stock investment in the company by that same amount. Okay. Now we have this next trick question here, asking you to do something, but in reality for this class, all we need to know is a consolidated return. Okay, so let's move on to recording from the buyer's perspective, purchase of a bond. Okay, again, this is going to be similar to what we already looked at last week on the sales of bonds from the seller's perspective, but also slightly different. Okay, so we are going to debit bond investments and credit cash. Okay, that's going to be initial transaction here. Assume a corporation purchased 50 $1,000 8% municipal bonds on January 1st, 2012 for $48,000. Bonds pay semi-annual interest on January 1 and July 1. Okay, so right now we're doing the initial entry. Debit to bond investments, showing that we're changing basically one asset, cash, into a different asset, bond investments. Okay, and again, we're not worried about recording premium, discount, that kind of thing like we talked about when we were looking at the seller's perspective. All we care about is what it costs us to buy this bond. Okay, so right now it costs us $48,000 and $48,000. Okay, so pretty simple there. Now we want to show the first interest payment. Since we bought on January 1, 2012, the next time interest payment is due will be July 1, 2012. Okay, so since this is $50,000 worth of bonds at 8% interest for the year, we're going to take half of that interest and pay it in the first payment. So we have 4% times 50,000. That's going to be our first interest payment. Okay, so that ends up being $2,000. So we're going to have a debit cash $2,000, credit interest to revenue $2,000. Okay, so that, assuming there's no financial statements that need to be done in between when the last bond or interest payment was made and this interest payment it needs to be made, this is what just a normal entry would look like. Debit to cash, showing that we received $2,000 in interest. Credit to interest revenue, categorizing that as interest revenue. Okay, so now we get to that scenario where we do have, in between this payment that we made and the next payment, we have to do financial statements right at the very end of the period. Okay, so for all intents and purposes, we have earned all of this interest. It just hasn't been paid to us yet. So instead of cash, we just are going to record a receivable showing that we are going to get this money in the future, very near future, and we are going to recognize it as revenue because we have earned it already as time passes. Okay, so as of December 31st, 2012, the only thing different between these two is we didn't actually get the cash. So instead of getting the cash, we are recording a receivable showing that we are going to receive it, and in fact we're going to receive it the next day. So the next day rolls around, and all we're doing is reversing out this receivable and showing it as cash. Okay, so debit to cash $2,000, credit to interest receivable, 2,000. Okay, so now we've reversed that out. We showed that the interest was paid, and we're good to go. So now let's assume that on the very next day after this interest was paid, A Corp decides to sell these bonds. Remember, we're not holding them to maturity. We bought them for the purpose of investing and hopefully selling at a higher price. So now, when we bought them at a discount because the interest rates dictated that they could be sold at a discount. Okay, but now interest rates have gone up, and we're going to sell them at a premium. So, two things that we're concerned with here. What did we pay for them, which was right here, and what are we selling them for? So the amount we're selling them for shows up as cash, okay, because that's how much money we're getting. Then we do want to show that this account here, bond investments, showing the asset of the bonds, is going away. Okay, so it used to be a debit, 48,000. We're going to credit down here, bond investments, $48,000. Okay, but are we done? No, we're not. If this does not balance, and what we're missing is $4,000 credit entry here. So what this is going to be, since cash we received is greater than what we paid for it, we are going to recognize a gain. Okay, so it's going to be gain on sale of bonds, 4,000. Okay, and there you have it. Debits and credits balance. We canceled out our bond investment, and we showed how much cash we paid.